In this video, traders, we're going to look at 7 risk control tips from the market wizards. Stay tuned. Hey traders and investors, a very warm welcome to you. So I have in front of me Stock Market Wizards books, Stock Market Wizards, one of the Market Wizards series by Jack D. Schwager. Really good series of books, talked about them before, recommend them highly. This is one of them in the series, and from this book I have 7 risk control tips from the Market Wizards. So let's look at them and let's see if we can take some of these ideas to integrate into our own risk management procedure for our own trading. Okay, first one is stop loss points. So this sounds pretty obvious, right? Stop loss is what we should do. So there's a couple of guys in here that say that, hey, they've got to predetermine where they'll get out of a trade if it goes against them. This allows them to limit the potential loss on any position at a well-defined risk level. So, hey, listen, this is basic stuff, guys, but surprisingly, people still trade without stops, without managing risk. Now, is it the only way of managing risk? No, it's not. And I've done a video on this before where, we all talk about stops and risk management, but as long as we have an adequate risk management in place, we don't necessarily need a stop loss. I know I'm probably going to get blasted for that in the comment section below, but there are other ways that people manage risk. For the majority of us, stop loss points is where it's at. So setting the point in the market where you will come out if you are wrong is the best way of managing risk. But there are others. Let's look at others. 2, reducing the position. So Mark Cook actually has a sheet taped to his computer that says get smaller, and the first thing he does, he says, when he's losing, is to stop the bleeding. And even Steve Cohen has got an identical thing where he says, if you think you're wrong, or if the market is moving against you and you don't know why, take in half. In other words, cut position in half. You can always put it on again. If you do that twice, you've taken in 3/4 of your position, then what's left is no longer a big deal. Massive, great tip, this, guys. Really good. If you have let's say you do have a stop loss that's a long way away, for example, or you don't and you're running from reducing position. If you don't like it, or if you're in a losing position, the wizards say this: trim that position, take some off the table, make it so it doesn't hurt as much. You can always put it back on. And yes, I realize there's a fine line between kind of taking it off when it just goes against you, put it back on high, and getting whipsawed that way. But the point is, gives you thinking time, gives you clarity, allows you to manage the position with more thought and less concern about the loss, the financial loss, and more thought about the quality of the trade that you're in. Okay, the next one is selecting low risk positions. So some traders rely on very restrictive stock selection conditions to control risk as an alternative to stop loss liquidation or position reduction. So they are making sure the stock is under very tight trading conditions. In other words, they're not looking at kind of tech stocks, they're not looking at stocks that are binary events, biotechs or exploration companies like that. They are in kind of smaller stocks with lower ranges. There's not any surprising news coming on, and that suits them because they haven't got that open-ended risk. Of course, the flip side of that is potentially you're limiting your upside, but hey, we're talking about managing risk here, not the kind of other side of the coin. 4, limiting the initial position size. This sounds pretty self-explanatory, right? But Cohen says, hey, a common mistake that traders make is that they take on too big of a position relative to their portfolio. Then, when the stock moves against them, the pain becomes too great to handle and end up panicking or freezing. Okay, and was another thing here. Elliot Volk, or Volk probably his surname is, says never make a bet you can't afford to lose. Great insight, and something I know I've been guilty of, taking positions that are too sized, too aggressive. You don't need to be that big. The sweet spot is to go in and scale into the position as it's working for you. Your initial position size doesn't need to be so big. That's when the risk is the most. Let's say you take a quarter line that you're going to take, it goes in your favor, you add another quarter, goes in your favor, another quarter, pulls back. You can build the position based on pyramiding into it if you want to build a big position. Building a big position just from standing start is generally a dangerous game. And exactly like kind of Cohen says it's a mistake that the traders make. They take on too big a position right off the bat, and it goes against them. The pain comes great to handle, and they have to freeze or they have to liquidate, and it hurts them. All right, number 5, diversification. The more diversified the holdings, the lower the risk. By diversification in itself is not a sufficient risk control measure because of the significant correlation of most stocks to the broader market. That makes sense and hence to each other. Also, diversification can have significant drawbacks, but the point is here for risk management, guys, is that you want to be in a broad selection of markets. You don't want to be, and this was talking from a stock perspective, and the point is here, if you're in a multitude of stocks and the market's going up, you're going to have a lift up. If it's going down, you're going to lose money. So it's a bit of a fallacy, but from our perspective, maybe we can trade long US dollar, maybe we can trade kind of long Apple, maybe we can trade short DAX. There are some slight correlations to those, but there is a diversification there that's reasonably far enough apart that you're not going to be so effective. Not like trading long Dow and long S&P, which are kind of tightly wound, and if they both go up, they're going to go up together for the majority of the time. So diversification to reduce the risk or the portfolio risk. Number 6, short selling. So short selling, actually, this is interestingly because most people think of short selling as risky, and it does say here that the common perception is that it is risky, but it can be an effective tool in reducing portfolio risk. So the idea being that you have a basket of stocks that you believe are going to outperform the market. You might sell some S&P 500 futures, some NASDAQ futures to limit that downside risk. Sure, you're going to cap a bit of the gain, but the idea is if the market plummets to the downside, you have some profit from your short position, your short futures positions, offsetting the loss from your wider portfolio. So it's a way of kind of, I'd say short selling is a hedging, and we'll come to hedging in a second, but it's a way of having some kind of hedge in place so that you do limit that downside risk. At the end of the day, guys, we are all trying to make as much money as possible, but the most important thing is that we limit the damage when we get it wrong. The final thing is hedge strategies. It says here some traders use methodologies in which positions are hedged from the onset. These traders risk control as a matter of restricting leverage, since even a low risk strategy can become a high risk trade if the leverage is excessive. And an example of that is LTCM, of course. So hedging, we're pretty familiar with that. That could be buying something that's an inverse of what you're trading, or that has an inverse correlation, or you have, like I say, some short positions. Maybe you're putting in some put options or call options if you're going short, that kind of stuff. So that's ways of managing risk. So the important thing in summary from this video, guys, is that, hey, stop loss is the main one and one we lose, but it's not the only way of managing risk. These other ways are ways of managing risk. They work on a kind of different way, and sometimes the risk isn't as finite as it would be with a stop, but it allows you, it's a strategy nevertheless for limiting the downside on your trades, which is what risk management is all about. Anyway, whatever you're trading, whatever time frame, whatever market, keep your risk managed, guys. I'll see you in the next one. Take care. Bye-bye.